Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. The stock market is up nearly 15% so far in 2023, which makes this one of the best starts of the century, which basically means since 2000 because that's when this current century started. But here's the thing that you need to know. Tech stocks have been great this year. That is the sector that is doing the absolute best. Microsoft, Nvidia, Meta, so on and so forth. That we already know. And if that sector is rising and that is where the money is going, that means the money has left somewhere. And if money has left a certain sector, that means that those stocks are leveling out and starting to fall off. So, is this the time for you to sell? And in what areas of the stock market are kind of falling apart or at least slowing down? So here's the thing. I say this nearly every year, especially around this time. What worked last year might not work this year. What worked last year? Insurance stocks worked last year. Defensive stocks, inflation-resistant stocks. Those are all the companies that did extremely well last year. I talked a whole lot about GPC, Genuine Parts Company, AutoZone, O'Reilly's. All did well last year because they were defensive. We thought we were going into recession. Inflation was high. The Fed was raising rates. Nobody wanted to go buy new cars, so they were going and repairing their cars at O'Reilly's because nobody wanted to pay for all the other stuff to get their cars done, right? Same thing for a company like SJM, Smuckers, peanut butter and jelly. If we was going into a recession, people were still buying peanut butter and jelly, and it was a solid defensive stock. It's flat. It's kind of right now. A company like Progressive, one of my favorite stocks of last year, was doing incredibly well. People were paying their insurance premiums, and it was something you had to have. Almost all insurance stocks last year were doing incredibly well. But United Healthcare tapered off. Progressive starting to taper off a bit. What do we do now? Here's your thing. There are a few ways that you can look at this. Number one, you can say, look, I'm going to take my gains or cut my losses and move to where the money resides. And right now, that is tech. Now, there are some risks in doing that. We'll talk about that. But there's one option. It's just say, look, for me right now, I'm up on Smuckers by a little bit. And I'm up still on Progressive. Now, it used to be up like 20 some odd percent, but it's starting to taper off. I can say, look, I'll take my 8%, I'll take my 9%, which is still very, very good, and cut it and just move on somewhere else. That is an option to you. Or you can cut your losses, as I mentioned earlier. I will say this, some of the best investments you can make is by cutting your losses after you've been around long enough. When I say long enough, I mean at least 6 months, because research has shown us that that is a decent time frame to predict what the next 6 months is going to do. Not a guarantee, but a decent time frame. It's also talked about inside the Intelligent Investor as well, that exact time frame, and inside our book club we had talked about it. An example for me is I took my money off the table for Nike about a year or two ago. People got mad at me. I don't know why you got mad at me for selling my own stock, but hey, Nike fell after that. Same thing with T-Mobile. T-Mobile had stopped doing well. I got out of PayPal. Thank God I got out of PayPal when I did. I lost like 25%, but PayPal fell further all of last year when it was down like 70 some percent. Same thing with Block. Disney I let go of. That absolutely fell apart. Target I got rid of and took a loss and has absolutely fallen apart for more than 18 months now. So hey, sometimes cutting your losses is the absolute best thing that you can do. So this could be the opportunity for you to do that. The other thing you could do is you continue buying low if you feel like this is a valuable company that you know you are going to hold for the long term. And these are all things that you're going to have to wrestle with on your own because I don't know what you own. For example, for me, for Smuckers, because someone had asked me this on Instagram, whether or not I'm going to get rid of it. I am barely up on that stock. Like if I'm making 2% on Smuckers right now, I'd be surprised. However, when I actually looked at my account, I actually made way more in dividends than what I did in the gain. I might just be fine with those dividends, continuously reinvesting those or holding them. When I consider the dividend payments that I've been getting, I'm actually quite profitable there. So it could be something that I could continue holding, but that is something that you want to consider. The last thing that you should consider if you are looking to shift over your portfolio or make changes is look at what you currently have. What you don't want to do in most cases is just say, oh, tech is doing well, let me do everything in the tech space and put all my chips there. It might work. You are taking on a big risk and you might be rewarded for that. But remember, it didn't take much for tech to fall apart last year. And we don't know what's going to happen by the end of the year, and we certainly don't know what's going to happen in 2024. I am confident in tech. I think it will do well in 2024, but it's early. Okay, and people can be wrong about where we think the economy is going to go. Remember, in November and December of last year, all these tech companies were, for the most part, were cutting people left and right, and people were concerned about where they were going to go. We were talking about Meta wasting billions of dollars in the metaverse and how that company was completely lost. Now look at them. So we'll see where they go here in the next year, in the next 18 months. But you do want to be careful there. One way that you can avoid that by just going all into tech, there are two ways to do it. Number one, you get an ETF. One of my favorite ETFs for the tech space is QQQ. It has the top 100, or largest 100 tech stocks all in one package. So if you want to add tech and you don't want to have to search through and see which one is good, which one is bad, get that and you'll be fine. Very good long-term investment there. Another way is look at your current portfolio and see what you have, right? And you could make some replacements as opposed to some additions. So for example, already own Google, Microsoft, I own a tiny sliver of Amazon, and I own IBM. Well, instead of saying, well, I just want to add NVIDIA, I just want to add Meta, and add Cadence Systems, the stock we talked about in our members only, I could do that and have 3 additional tech stocks, or I could say, well, let me just replace IBM. I have IBM in my portfolio. It's okay. Maybe I'll just sell IBM and put in a stock that I think will do better. That way I have the same amount of tech without pushing myself over the edge. So that's another way that you can look at it. Just because a company is slowing down now doesn't mean that you absolutely have to get rid of it. O'Reilly for me is slowing down, but because I bought it like 3 years ago now, I'm still up quite a bit. And it just could be just a flat era, right? And next 6 months it could do better, or next year it could do better. Just because it's flattened out and it's slowed down doesn't mean you absolutely have to sell. But what you should do is sit down and say, is this a return I'm okay with? Is this a company I believe in long term? Do I think the future is brighter for said company or not? That is totally up to you and what your expectations are. But I'm telling you now, and we've noticed it, it's been more than 6 or close to 6 months now, that people are not interested in defensive stocks anymore. Okay, the market is not interested in defensive stocks anymore. When everybody was running for the hills and inflation was the biggest story in the world and was at 9%, we ran to inflation resistant stocks. That's where people were going. Now that inflation is falling off, they're leaving that area and they're going to the places where they think they can make the most money, which tends to be in tech. That's the trend, and it's your choice from now on until this trend changes to either swim uphill and swim against the river, whatever that tide, go against the tide is the word I'm looking for. Go against the tide and take it the hard way by continuously buying some of these defensive stocks or holding on to them, or you can go with the wave and go in the direction that the entire stock market is going. I can't tell you which way to go, okay? Well, I can tell you what I'm gonna do. Okay, what I'm going to do is I'm going to make small adjustments to my portfolio and really make some replacements. So I haven't made any definitive decisions yet, but I would probably replace IBM. I've made some money, but I could make some more. So I could switch out IBM for another tech stock. Some of the other defensive stocks last year, I might switch those out, but I don't really plan, at this point in time, I don't plan on adding any brand new tech stocks because I already have a decent showing of tech already, so I don't think I need to push myself in that direction, but I could make better, more efficient choices. So if IBM is not the best tech stock out, maybe I can flip that and turn it into something else. If Progressive is slowing down and there's another stock that is not tech but doing well, perhaps I can switch that into something else. Right now, I don't know what those answers are going to be for me yet, but however, when I do come up with those answers, you know where I'm gonna go first? I'm telling everybody in my members only. So if you're in the members only, you're going to get a note from me at the end of this week of what I'm going to sell, and you'll know before everybody else what stocks I'm looking at to actually buy. Now, what you do with that information is totally up to you. I'm just telling you what is in my financial plan and what I'm planning to do. So our members are going to get it first. They're going to know everything before it hits public and everywhere else. So choice is yours. Just letting you know that. Okay. All right. That is it for me. Also, Insider members only, in case you missed it, the top 5 stocks that I think are off the radar, I took them and ranked them Insider members only as well, based on the value. There were 2 stocks at the top that I absolutely love more than the rest that were on the list, and there were some companies that I believe are overvalued by a mile. So you definitely want to take a look at that. All the stocks are doing quite well, but again, it all depends on what you pay for it, right? All right, that is it for me. Talk to y'all tomorrow. Bye.